All right, now we've been talking a lot about evaluation of deficiencies, and maybe we'll turn back a little bit more to high level in ICFR. Mark and Rick, why don't you talk a little bit about the process auditors go through, the top-down approach to identify and determine which controls to test?
Yeah, so when I think about it, you want to think about, well, what accounts and process are in scope. And it's really an integrated audit, so that should be one and the same. And for the most part, I don't think there's a whole lot of challenges or questions around that. Now, obviously you can get into complexities with a multi-location, but that goes hand in hand with the financial statement audit and the controls. But then after that, and you say, okay, here are the accounts and processes that are in scope, it really gets back to understanding the end-to-end process when we talk about a top-down approach. And understanding that end-to-end process is not just saying, I've walked through and I know how management now has something from initiating a transaction until it's recorded the transaction. If you really want to have that robust understanding, you got to keep asking yourself, well, what can go wrong, right? And asking what can go wrong, and you say, okay, well, that's something that could go wrong. The next question is, well, could it be material? And if it's material, well, now, okay, the next question is, well, what controls does the company have in place? If they don't have controls, now you get into design issues. If they have the controls, it's not just evaluating that maybe one control, but there might be other controls supporting that, right? So if you have a review being done, okay, that's great. If that review is relying on a report, are there controls around the report to make sure the information is complete and accurate? But that's how I think about the top-down approach. It's focused on what can go wrong and what can be material when you answer that question.
Yeah, I think I'd add that one of the things that experienced auditors come up to is that what could go wrong is not necessarily unique to the facts of that organization. So you would expect as you look through the planning work of most audits that you'll see a lot of a higher evaluation around accounts with large estimations as something that could go wrong, right? Not only could that be manipulated, frankly, management groups are frequently not objective themselves, and they always think that maybe they're better than they are, and therefore they're always above average in terms of their outcomes against industry and all those sorts of things. You'll see that in the results. So I think when you start asking yourselves, what are the things that this company does not handle routinely? What are the things where there's a lot of judgment involved? What are the things where new accounting pronouncements have been put into place? Those are the kind of secondary questions you're asking to the what could go wrong to help define and decide what could go wrong. And if you do that well, that is often where these problems arise.
And you touched on, let's talk a little bit about some of these areas. You'd think revenue, fair values, pensions, pretty significant things. Those are the areas we seem to find more internal control problems. Why is that? You'd think that the controls will be stronger in those areas.
Yeah, well, I think it starts with, you are talking about complex areas, right? And they're complex from an accounting perspective, so you expect it's also complex from a controls perspective. And each one I think may be a little bit different. Like when I think about revenue, it might not be an issue around the main revenue stream, right? But then often companies will have different revenue streams, and it's a question of, well, is the process the same? And if the process is not the same, we got to make sure then we understand what can go wrong in each one of those revenue streams, and I think that's where the complexity is. I think you also get complexity around the revenue recognition, and then to Rick's point, if you have a restatement in the revenue recognition area and it's something nuanced, is that really an indicator that they had ineffective controls over all of revenue, or are we talking about really more of a specific area? But because of the complexity of the accounting, you'll find those issues. And then when I think about fair value and pensions, to me, I think you get into some of the complexities around that is often that you have a management third-party specialist. And so now you're asking the management team, what are your controls around that process, and how are you comfortable with those assumptions that may have been developed at a third party? And they need to have controls around that. And part of them, they just want to say, well, that's why I hired them, because I've outsourced that part of the process. And so you get into a lot of complexities around that area with the assumptions.
Yeah, maybe two examples that speak a lot to what Mark said. We had a situation where a company ended up having problems in revenue recognition. Processes were well-defined, policies were well-defined, standards were well-defined, and yet we found that in one country, socially, they just didn't adhere to a certain contract term ever, just the way it worked. And U.S. management didn't know that they didn't adhere to the contract term. But we discovered that, and because our colleagues that we were working with in that country said, nobody ever does this. Okay, and so you find things like that are you might think of one-off, but they're not. They're process-driven. You write rules in a country where the rule of law is very well supported and enforced, and you go to other locations where perhaps what's written isn't all that necessarily important. I think the other issue, and this is one that's a little bit tricky, but sometimes we might call something a material weakness of the company. To the dying day, the company officials will say it never was. And that happens around estimates for fair value and pensions were just described. Fair value, as probably pretty much everybody in this audience knows, there's a hierarchy of fair value, and 3 levels of evaluation of how well fair value is established. And when you get into those level 3 kind of estimates, they can become fairly complex, very debatable. At the end of the day, if the auditor thinks the estimate the company used is not within a reasonable bound, it's wrong. I mean, by definition, it's wrong. It may not be wrong, but because we are the auditor, it's wrong. And that the estimate area can be very difficult because of that. I think most auditors could find at least one instance in their life where they disagreed vehemently about an estimate with a client, and it turned out the client was right. I have a couple of those in my background, and it's embarrassing. But at least in the old days, before it was an internal control problem, it was just we disagreed. But now it's not only disagree, but because we have to conclude on the estimate, and if it's materially incorrect, it's a control issue. You get into a little bit of definitional issue there. That's a little bit of a struggle. I don't think it's a high number of what's going on in here, but you do run across that from time to time.
Good. Interesting. So as we think of what we've talked about internal controls a challenge for the profession. We've talked about how hard it is to quantify these things. And you can kind of bring it around and convince yourself, here's all the reasons why this is so hard. But then let me throw it back a little bit and say, gee, the profession's been dealing with difficult issues for a long time, right? So, and if you think of some of the areas we talked about, Rick, in revenue and critical areas, even the example you had of the company that the country didn't understand the local customs, you'd think that the business would know their business. So you think these are the areas that should have the strongest controls, not really because they're worried about financial reporting, but because they're trying to run the business. So why is it that we think we struggle so much? If you're in areas that should have strong controls, what do we collectively think is I'd say, the profession's challenge?
Well, I really do think the profession is ahead of the companies by quite a bit. And by definition, we come in behind. Right. And that creates, it's somewhat the same way that the PCAOB has driven the profession through the inspection process to do things differently and better. An awful lot of that has come through having what you did do be found deficient. You learn why it's deficient and so forth. That's not a tidy way of improvement. It's not tidy at all. But it can be effective. And I really think that as we have more people with control knowledge built up within the various companies, I think that will close the gap in that area.
Mm-hmm. And I think also part of that you see is, and it might have been touched on earlier with Rick, is what's the evidence that control operated effectively, right? Because a lot of times companies are having a lot of conversations. They do know their business, it's second nature to them. But then when you come in and say, okay, well, now I need to test that control and test that process, you know, it's more, they might have the knowledge and speak of it, but it might not be, well, here's exactly how I reviewed it. Here are my, you know, notations about the review, because a lot of it is more maybe in their head. And that's where it can get difficult in trying to test the controls and trying to think about it. And especially when you might be evaluating the severity of a deficiency, and then people say, well, if it would have been material, I would have caught it. And it's sort of, well, okay, I'm not questioning your ability and your competency to do that, but I also, you know, what's the control that you can point to that would say that could be done? And that gets to be very difficult, and it's hard to put the arms around. And as auditors, we're used to saying, you know, we're trained to evaluate all the evidence. But in this situation, we have to discount what we found in the substantive work. So it sort of goes against what we think about.
Right. What about views in the perspective of, do you think the business and the profession maybe has gone into internal control treating as a compliance exercise more so, and that's why it struggled a little bit with having the sense of urgency, both in the companies as well as on the audit teams?
You know, I think part of that is that I think there are two things that got us sort of down the wrong path. You know, AS2 was so granular, and so there was just a lot of volume to think through. And then secondly, I think that all of us as human beings tend to gravitate toward the things that we are pretty good at, and the control activities around high volume, repetitive tasks, easy to validate, easy to verify, which is the highest percentage number of controls that you test, out of the gate, that's where a lot of the energy went. Because that's what we, frankly, again, you go back to 2004 or 5, most of us hadn't reported on internal controls, and we were still working to get our heads around this whole framework, and those were the controls we thought about and knew, and so I think people ran to that piece first. And so I think we had to do a reset, and that happened a few years ago, and I think we're now asking these right questions, although I think we haven't quite yet reached a common vision on how you move forward on them.
And I do think we probably are seeing that movement, and there was maybe a mindset it was more compliance, but I will also say when you talk to engagement teams, and the more we focus on that end-to-end process and what can go wrong, they will say, well, it's not just a better control audit, I have a better financial statement audit, because now I really understand even more where the risks are and where I should focus. And so, you know, hopefully trying to meet the true objectives of an integrated audit through that process.
Right.
Yeah, Frank, I would go back and say, also, change is hard, right? The easy stuff is already solved. And if you take the difficult issues, you get people around a table and they work away at these problems, then once they solve them, those become easy things. And we think, oh, everybody should be able to do that. If you go back 100 years when people were trying to figure out how to audit financial statements, things that we take for granted today used to be really hard problems. So change is going to be slow, and it's going to be evolutionary. And I think we're just in that process where we've come a long way in a decade, but it's just been a decade.